How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic I want to discuss with you TSP withdrawal options, and specifically regarding thrift savings plans. So this is going to be for a lot of the governmental workers that have thrift savings plans. Whenever you see the word TSP, kind of think of it like a 401k, but for federal employees. Essentially, what's happening is an individual is working for a federal agency, and every month, very similar to a 401k, they have that option to take a portion of their salary and place it into a type of retirement account. So each and every month, when we extend that out through years, they're placing more and more contributions into this plan, and then this plan is typically linked to some sort of mutual fund options that this individual could choose regarding this TSP. So in theory, as long as an individual keeps placing more and more dollars into this and the markets that are linked to this mutual fund account are going up, then you're going to have the combination of growth regarding the contributions that are being placed into this plan, and then also the interest credit that is receiving back from those mutual funds into that plan to grow this bucket larger and larger and larger. Unfortunately, we've seen negatives to these types of accounts, like in 2008. The stock market obviously had its way with 401k related plans, retirement plans, and it made individuals panic and very scared, leaving their money, saying, "Okay, we're just going to place this into a guaranteed G fund, and just so that I have a return of my money rather than a return on my money." So today's topic I want to discuss, right when you're coming near retirement, you've essentially accumulated buckets into this TSP, into the thrift savings plan. What's a proper strategy on how to pull these monies out to make sure that A, you're not outliving these monies, you're segmenting it out properly. You actually have a strategy rather than shooting from the hip and just saying, "Oh, I'll just sporadically pull these monies out, and the market should always be going up, so therefore I have this big question mark on what exactly is going to happen with retirement." So let me clear off the screen. And I don't mean that first portion to be a little Cliff Notes version of your retirement planning, but ultimately, in a nutshell, that's exactly what what occurs with the TSPs. So now it comes time that maybe this individual is 60 years old and they're looking to retire. So they're looking at their options and they're saying, "Okay, if I'm working for the government, I'm going to possibly have Social Security income." Let's say if this person wants to retire in 5 years, as an example. This individual understands that they might have Social Security income, depending upon how they set up their retirement accounts, but most likely they're going to have Social Security income coming to them. They might have some form of pension income that's going to be coming to them. And then they're going to have combination of retirement savings, such as cash accounts, savings accounts, IRA accounts, Roth IRA accounts, and then their thrift savings plan accounts. Majority of the times it's just going to be that thrift savings plan and then some savings accounts, but let's just say that they have a whole slew of different retirement accounts. What exactly is the best way on how to pull these monies out? Now, many times individuals make the mistake and they say, "I'm just going to leave my money in the TSP and then sporadically pull it out, or take the annuity option with the TSP," and understand that's only one option. With the annuity, you're utilizing the one company that allows you to pull out that annuity option that houses that TSP. And they're going to say, "Okay, you have X amount of thousands of dollars in your thrift savings plan. We can provide you an income stream, a lifetime income stream for either yourself or you and your spouse of X amount of income." Understand something, this is completely separate from the pension income. One of the very quick fixes on this is to see exactly what your options are. See what your options are on a private sector, meaning right when you hit age 60, you have certain options that you could take these TSP monies, and if you're looking to trigger lifetime income, why would you just go with that one option that they're saying through an insurance company to provide you an annuity stream, where you could go and say, "I'm age 60, I live in X amount of state, and I could go and see what the best annuity options are to receive income from this account." So maybe the TSP annuity option might be providing this individual $10,000 of income each and every year to the day he passes away, as opposed to taking this full lump sum, going on the private market and saying, "Okay, maybe I could get $20,000 of income." Very realistic example. Once again, if an annuity payment is your goal, well, then understand that you have different annuity options for that. What we like to see is something that's more specific, something that You're only placing, because with annuity payments, the downside to that is you're receiving lifetime income and you're not really receiving too much growth back into those accounts. You're just utilizing an annuity, you're utilizing that insurance company to produce you lifetime income, kind of like a paycheck in retirement. Very similar to the Social Security, very similar to your pension income stream. But if there's a way on how you could actually figure out what your number is, well, then you could make sure that you're setting this up in a more efficient manner so that you could grow this monies for whatever you do not need in the lifetime income stream, and you're maximizing out what that lifetime income stream is. What do I mean by that? Let's say we have an individual, a male age 60, is looking to retire at age 65. And after doing his budgeting analysis, we determined that he needs exactly $60,000 of income at age 65, and that's what's going to get him to his retirement goal. We know exactly from the nuts and bolts of everything regarding his expenses, what are going to decrease in his expenses, what are going to increase in his expenses each and every year at age 65. What exactly is that number? Let's say it determines that it's $60,000. This individual at age 65 could be triggering Social Security income of, let's say, $20,000, and then pension income of another $20,000. So this means that he has $40,000 of lifetime income right now, and he has a TSP account that's sitting there with lump sum of money, let's just call it $500,000, and he has a gap. 40,000 minus the 60,000 is a gap of another $20,000. So this is what he needs to figure out by the time he hits age 65. Well, there's a way to leverage his TSP monies, whether he's working for the agency or not. They have a Rule 60 where you could go and pull out a portion of your TSP account and roll it over into a specifically designed IRA contract to provide you lifetime income. So in this example, let's say out of this $500,000, this individual only needs to take $200,000 out of his TSP to trigger the best IRA contract that will give him with an insurance company, because insurance companies are the only ones that could offer this, that will provide him lifetime income with exactly that 5-year deferral. So what happens with these types of accounts is they have $200,000 that got siphoned out of the $500,000 account. That's getting triggered at age 65 along with his Social Security, along with his pension income. And now it fits like a perfect puzzle piece saying $60,000 is my goal. At age 65, I'm receiving $60,000 of lifetime income. On top of it, you could set up something known as a laddering strategy, which takes his $200,000, segments it out so that he's getting $20,000 at age 65, and then every couple of years he's stepping up with income by a few $1,000s to make sure that we're incorporating for inflation. The bigger picture of this type of idea, this type of account, this type of strategy is saying now this individual has $300,000 left over in his TSP. $300,000 that now he could risk into variable accounts. He could risk it into the market. Many times individuals make the mistake of they take this full $500,000, they're age 60, and they say, okay, at age 65, I'm just going to keep siphoning out $20,000. The reason why that's a problem is because they fall victim to something known as reverse dollar cost averaging. They're siphoning money from an account that has fees and that could potentially go down. So typically when somebody's leveraging their TSP accounts where they're going to have TSP related fees, not their TSP related fees are very minimal, but understand that they're still negative there. Also, the mutual funds that they choose are going to be an extra fee associated there. If you're looking to really optimize that account, they typically want to leverage financial advisors for that. Well, that advisor is going to charge something known as an advisor fee. The third negative is downward market loss. Just like in 2008, the average portfolio received about 50% loss. If that occurs again, especially when you're looking to leverage that $20,000 for income, that's a problem. Let's just say that this individual wants to go and pull out the $20,000 of income and the market goes down 10%. It loses a $50,000 loss, and this person is paying advisor fees of $5,000 and then mutual fund related fees and TSP fees of another $5,000. This individual would have taken a loss of $50,000 from their account, just a 10% loss, $50,000 of their account. They would have had to pay another $10,000 worth of fees, plus minus $60,000, and then this individual would be pulling out $20,000 for income, minus $80,000. So in that 1 year, this individual started with 500 grand, decided, okay, I left my monies in the market. That's how I grew my account. I never set up an actual safety net account. I never set up an actual plan for these monies, and I just kind of let it ride. Well, now walking into the next year, he's only going to be at $420,000. So even if the market goes back up 10%, you still have to incorporate pulling out an additional $20,000, which is only going to increase for inflationary expenses to adjust for inflation, and those fees are still going to be remaining there. So what you have is an uphill battle struggle that could liquidate these accounts. And this is why individuals, majority of seniors, about 80 to 90% of seniors, currently are outliving their retirement savings. And they have to rely on things like pension income. They have to rely on things like Social Security income. What I'm trying to show you is ways on how you can leverage your TSP accounts. Make sure that you're leveraging them out properly, of saying, okay, out of my bucket, because I hit age 60, I can now roll over a portion of those monies into a properly designed IRA account with an insurance company that will give me lifetime income, whether that's for me, whether that's for me and my spouse. I can ladder that out properly to make sure that I'm receiving $20,000 at age 65 in this example, and then receiving step-ups in income for that inflationary protection each and every year going forward. With that in mind, we have $300,000 that now you could use as fund monies. Now you could use to push the pedal to the metal and be more riskier with your specific types of accounts, because if the market goes up, excellent. Now you can take that extra vacation that year. You have your $300,000 as extra emergency funds. Now understand, this is just an example. Some individuals might only have $200,000, might only have $300,000 into their accounts. But it's all about segmenting it out like a perfect puzzle piece. How exactly can you set up your plan properly to make sure that you're making it most efficient for lifetime income, so that you do not have to dip into these additional monies. The ultimate goal is to leave as much money into variable accounts into the market as possible, but you need to have that safety net there first. That is where these insurance contracts with IRA set up through IRA, so it's a complete TSP to IRA rollover, can take place. So that's a TSP withdrawal option. That's something that we do in our office very successfully, and this is why we have a lot of national volume that comes in. So you obviously see the number on the screen, 1-800-566-1002. What you can expect when calling in, 24/7 customer service. You call in, you ask to speak with a specialist. You say, I have a thrift savings plan and I need some help. I'm not sure exactly what I'm doing is correct. And you're going to get educated. We're going to have an expert speak with you and tell you whether what you're doing right now is going to accomplish your goals. And if that's the case, then there's no need changing anything with your specific plan. If you already have your bases covered, there's no reason to go and place dollars into a specifically designed IRA contract. Now, unfortunately, majority of individuals are at risk of outliving their retirement monies and fall victim to variable risk, and they leave their monies at much higher risk than what their actual tolerance is wants to allow it for. So what we're trying to do is make sure that we're having that conversation. We're getting you guys educated on that, and if there are certain gaps, we're going to show you solutions specific to your age, specific to when you want to retire, whether you're currently retired or gearing up for retirement. Which are going to be the best contracts for you and how to segment your dollars properly. It's all about leveraging your chips properly. So whether you've already played that accumulation game, how exactly can you accentuate your income streams properly for your actual goal to make sure that now whatever's remaining over could now be accentuated back into your accumulation. So don't go into retirement income planning with an accumulation mindset. Make sure that you're covering your bases first before you go into that accumulation mindset to therefore utilize your fund monies and incorporate nice growth and consistency with your accounts. So I hope that you guys found value in this. At any point in time you want to give us a call, 1-800-566-1002. We have specialists standing by. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints, and it's because of this methodical process. Hope you enjoy and look forward to speaking with you. Thanks so much.